impact of COVID-19 on the corporate credit market. My name is William Cox, and I have the privilege of leading KBRA teams that cover corporates, financials, and government ratings and research. As you undoubtedly know, KBRA has been a leader in publishing and speaking about the immediate impact of COVID-19 on credit ratings and sector outlooks across many market segments, including real estate, asset-backed, transportation, energy, municipal finance, project finance, aviation, banks, and many more. All of this research is available free of charge at kbra.com. In producing this research, rest assured, KBRA is deploying the steady hands of highly experienced analysts who have earned their stripes through prior credit cycles and who remain committed to data-driven analysis rather than emotion and headlines. As an NRSRO, whose ratings are eligible for new Fed and Treasury programs, KBRA also looks forward to serving the credit market's needs in new ways in the days ahead. Today, our guests and colleagues will take a broader view of how the corporate credit market stresses are unfolding and where they may be headed. I promise that our speakers have unique and provocative things to say, including some things about today's federal announcements. Helping lead our discussion today is KBRA's trusted senior advisor, Professor Ed Altman. Dr. Altman is the Maxwell Hine Professor of Finance Emeritus at New York University Stern School of Business and Director of the Credit and Fixed Income Research Program at the NYU Solomon Center. Though he needs no introduction, Dr. Altman has an international reputation as an expert on corporate bankruptcy, high-yield bonds, distressed debt, and credit risk analysis. In fact, he is the creator of the world-famous Altman Z-score models for bankruptcy prediction of firms globally. His groundbreaking work in corporate distress prediction models, procedures for firm financial rehabilitation, and default rates in high-yield corporate debt have won him numerous awards and distinctions, and he continues to serve as an advisor to many U.S. and European organizations. Also joining us is Dr. Harry Mamaysky, who is an associate professor of professional practice at Columbia Business School, where he serves as the director of the program for financial studies. He is also on the steering committee of the Columbia IBM Center for Blockchain and Technology. And prior to his return to academia, Harry founded the Systemic Risk Group at Citigroup and served as a member of the firm's Risk Executive Committee. Previous to that, he was a senior portfolio manager at Citi Principal Strategies with a focus on relative value credit trading. Very relevant today, Harry's research focuses on equity, exchange rate, volatility, credit markets, and on the role of information in the trading process. In fact, Harry leads Columbia's News and Finance Research Initiative and has used large textual data sets, including news articles, earnings call transcripts, and central bank communications, all very relevant to his thought-provoking comments today. And kicking off our discussion is KBRA's own Van Hesser. Van is our chief strategist and previously served as the senior managing director in the financial institutions and corporate ratings groups, where he leveraged over 30 years of experience as an investor, sell-side research analyst, investment banker, and regulator. During his professional career, Van was named to Institutional Investor Magazine's All-America Fixed Income Research Team 10 times across 3 categories. And before KBRA, Van held senior positions at Wells Fargo, HSBC, CS First Boston, and Goldman Sachs, and started his career at the New York Fed. Van, thank you for being here today, and please take us away.
Thank you, Bill, and good morning. Thanks for joining us today. I'd like to set the stage a bit if I can, trying to mention a classic difficult to dimension crisis. Looking for context, we'll compare what we're seeing with COVID-19 to the global financial crisis, and we'll think through a bit what we think the recovery ultimately might look like. So heading into 2020, we were in the longest period of economic expansion in recorded history, fueled by global QE that drove rates to ultra-low levels, triggering in turn a search for yield on the part of investors that held their nose and accumulated risk. Credit risk, financial risk, and liquidity risk. Then the black swan appeared. The policy response has moved gradually towards shutdown and isolation, which has triggered economic collapse, defined by an unthinkable contraction upcoming in the second quarter with estimates 20%, 30%, and more, and never seen before spike in unemployment. As I was thinking through my comments, I came across Jamie Dimon's annual letter, came out a few days ago, and he seemed to capture simply what we're living through economically. A bad recession combined with some kind of financial stress similar to the global financial crisis of 2008. Well, that sort of sums it up. There's really a lot to unpack in that statement. So let's start with the recession. Bad for sure. B of A calls it the deepest on record, 5 times worse than the post-World War II average contraction. Full year forecasts have moved to a downdraft of around 5%, and really time will tell. Unemployment looks as though it will hit 15% in relatively short order. This is what a frozen economy looks like. So against this backdrop, you'd expect that corporate earnings would take a significant hit. With so much uncertainty, no surprise that there's a wide range of views out there. Consensus S&P 500 is stuck around 4% year over year, full year 2020, which just doesn't square with the worst recession we've ever seen. It's more likely that analysts working from home and without guidance simply haven't updated models. Estimates that are out there are as low as down a third to down a half in 2020, which we believe is far more likely and reflects the degree of sell-off in both the equity and credit markets. We would also expect a range of impact across industry sectors. So let's look at the first slide. Here we see a sectoral breakdown of the 11 S&P Spider sector ETFs, along with a few subsectors thrown in for good measure: banks, internet, and transportation. First thing to notice is that no one is spared. Every sector is down double digits. The S&P down 13%, and 34% peak to trough in the first quarter. As you would expect, energy, transport, basic materials, consumer discretionary names are at the epicenter of this crisis, no surprise there. What is a surprise, at least to us, is the degree of concern around the banks. Yes, the banks have largely suspended buybacks and rates are at or near 0%, but the degree of sell-off in the equity market implies that something more ominous is happening in the sector. Doesn't mean that earnings will not be hit. They will. Ultra low rates and will impact margins. Loan loss provisions are surely going higher. But the second worst performing sector, that feels like misplaced concern. Well, wait a second. Didn't Jamie Dimon cryptically throw in a comment about some kind of financial stress similar to the global financial crisis? He did. But we can only assume that he was talking about the drying up of liquidity across asset classes, some of which have been fixed meaningfully by the Fed at this point, and not concern over the health of the banking system. So that's one big change from the global financial crisis. But as we look for context to judge this unprecedented event, let's take a closer look at the GFC versus COVID-19. Like the pandemic, the GFC was a rolling shock emanating out of the financial system in 2007 that would ultimately result in credit crunch and economic freeze by the fourth quarter of 2008. GDP contracted at its worst point, 8% in that fourth quarter of 2008. Again, compare that to what we're seeing forecasted for this crisis. And unemployment peaked a year later in the fourth quarter of 2009 at near 10%. Unlike COVID-19, the GFC was highly politicized, which made fixing the problem difficult. But in the darkest hour, the government set up emergency funding programs for the banks, injected stimulus equal to 5% of GDP. Again, what we're looking at is 10% or more of current GDP in terms of structural support. The economy came back in the GFC's case about a year later, but unemployment took a while to reduce, didn't get below 8% for 3 years. In comparison, this crisis has the potential to be worse. More of the economy is frozen. Unemployment could be worse, right? McKinsey estimates that up to a third of all jobs are vulnerable. We just don't know at this point. It's hard to manage something you struggle to measure. That said, 2 developments of late have boosted investor sentiment. Signs of progress in fighting the virus right? We've seen improved infection numbers out of Europe and New York, and that has driven a bull market run here over the last couple of weeks. The second point I'd make is surprisingly large and surprisingly quick intervention on the part of the Fed and Congress to stabilize markets and provide relief to individuals, businesses, and state and local governments. On the latter point, the Fed's aggressive QE program, newly expanded this morning, and Congress's relief package, and not only provide massive liquidity support to markets and reduce the possibility of credit crunch, but also serve notice that fighting the Fed can be an expensive proposition. And both the Fed and Congress have made it clear that there is more where that came from. Treasury market disruption has settled down. The investment-grade corporate debt market has reopened to record issuance. High-quality high-yield names have been welcomed back amidst record inflows into high yield. Now, to be fair, those inflows have clawed back a third to 40% of record outflows, but funds are returning nonetheless. So at this point, most financial or market guideposts are better at this point in this crisis than was ultimately the case in the GFC. Financial market stress measures are well inside the GFC today. Credit spreads are well inside the GFC. Equity multiples are higher. PMIs, both manufacturing and services, are not nearly as bad as was the case in the depth of the GFC. Now, we hate to rain on a good parade, but we believe we are entering a more difficult phase, one defined by an acceleration of the health crisis. Remember, it's not just flattening the curve in New York or California. We do expect this to be a rolling phenomena that's going to hit secondary markets over the course of the next several months. You will see shocking economic reports. We keep getting those. First quarter earnings is going to come out. Not much interest in those except for the guidance, which we think will be dire over the rest of the year. And of course, concerns about getting stimulus funds out to people and businesses that need it the most. It's incredibly positive that with the size and the responsiveness of the federal government and Congress to put these packages together, getting that money out to people, however, is going to be very challenging. So let's go to the next slide. Over the balance of the year, we are skeptical that we will see a powerful snapback. Now, certain parts of the economy figure to bounce back quickly. Manufacturers will need to rebuild inventories and retailers will want to restock shelves. Basic materials, including energy, are likely to rally as the economy restarts, both in the US and around the world. But it's important to recognize that we will be different coming out of this than where we were going in. We believe individuals will be slow to evolve out of social distancing. They will be less willing to travel, less willing to attend large gatherings. We believe businesses, those that survive, will be more cautious in managing their enterprises in the future. They will diversify supply chains, maintain more inventory, hold on to more cash. Those all come, of course, with added cost. There will surely be those businesses that benefit: tech, healthcare, consumer staples, home delivery, but probably not enough to offset the broader headwinds in the economy. And judging by the risk market's performance since the bottom, March 23rd, after all, we are now officially in a bull market on the upside in stocks. Chatter has clearly moved to exit strategies from the shutdowns and social distancing measures. Trump administration said the economy could reopen in the next 4 to 8 weeks. Over in Italy, certain firms could open again mid-April. Austria and Denmark have begun to ease their public health restrictions, and other European countries are drawing up plans to follow. The evidence is mounting in that many countries' infection rates have peaked or are now in decline. But what will turn the tide here, to be clear, is a cure. While that still feels fairly abstract, here's a simple litmus test to use before we blow the all clear. Are you prepared to ride a commuter train or a bus or hop on the subway? Are you ready to go back out to a barber shop or a salon to get your hair cut? Are you ready to go to the movies or attend a large conference at a hotel? All of a sudden, it doesn't feel like we're ready to resume business as usual. So even when this is cured, the risk of a flare-up could be right around the corner, and who's to say we won't have one of those on a regular basis, right? This is the fourth epidemic or pandemic we've had in 20 years. All right, so let's go back to this pandemic. Getting through the period of search for the cure depends on the effectiveness of government programs in preserving as much of the economy Then we will be able to better account for how personal and commercial life has changed. Even then, we believe it will take quite even 2% growth in the US. So with that as a sobering backdrop, I'd like to turn it over to Professor Ed Altman. Ed?
Thank you very much, Van. Thank you also, Bill Cox, for your introduction. And good morning, everyone. And especially those who are listening in today, and also those who are observing the holiday, Jewish holidays today. I'm very pleased to be part of the KBRA presentation on the coronavirus crisis and its impact on financial and other markets. Thank you for mentioning my affiliation with NYU, which is now more than 52 years. I haven't figured out a way to get another job, so I'm still there. In addition, I'd like to tell you that the discussion this morning will be on the credit markets and the credit cycle, both before and after the realization in the United States of the crisis that we are now all facing. And so whenever I look at the credit cycle, I look at four major indicators, and I'd like to articulate those now. They are the default rate on high yield bonds. I've been very fortunate to be following this market now since its early inception in the late 70s, early 80s. And I think that's the epicenter to concentrate on with respect to defaults in our economy, bankruptcies, and the like. Indeed, the new Fed actions today are speaking directly to that issue. The second variable is the recovery rate, should there be a default on high yield bonds. The third variable is yields and yield spreads required by investors in high yield bonds and other risky debt instruments. And associated with that is the so-called distress ratio. That is the percentage of high yield bonds that are trading more than 1,000 basis points or 10% above the risk-free rate. Right now, today, about 10.6% yield to maturity, an option-adjusted spread of a similar amount. And finally, liquidity in the markets. Those four indicators were all indicating, or mostly all indicating, a benign credit cycle continuing as of the end of 2019. To give you a perspective, the benign cycle has been with us, or was with us by the end of the year since 2009, and therefore was just about 11 years now into that benign cycle. What was going on then was a default rate in the high yield bond market measured dollar denominated. These are my measures now, not necessarily the rating agencies or the investment banks, of 2.9%. And the historic average is 3.3%. So it's up, but not at the historic rate yet. In addition, the default recovery rate, that is the price of bonds just after default, at the end of 2019 was 43% for corporate bonds and about 60% for corporate loans. The recovery rates were slightly below historic average of 46% for corporate bonds, and were trending downward, which is an indication that perhaps the benign cycle was coming to an end at the end of 2019. The third variable, yields and spreads, very low at the end of 19, 414 basis points for bonds, a yield to maturity spread, and lower than 400 for the option adjusted spread. The distress ratio, percentage of high yield bonds trading above 1,000 basis points, was 8.2%, relatively low compared to the historic average as of the end of 2019. And finally, liquidity was quite high and buoyant. The last 7 or 8 years, it's been between $200 and $300 billion of new high yield debt issues, leveraged loans a lot more. And in the first 2 months of 2020, we had record monthly levels of high yield bond new issuance, and it looked like liquidity was here to stay. Unfortunately, things changed dramatically in March. I gave a speech on March 9th. Yield spread was up to about 550 basis points, an increase of 140 basis points from year end. And the distress ratio had more or less doubled to around 15% of high yield bonds trading above 1,000, a very important indicator. And liquidity more or less dried up. And that's been the case, except for now, the most highest quality ones in the high yield market. And so the indicators began to change in early March, and by mid and then the 23rd of March, things changed dramatically. Yield spreads went above 1,000 basis points, so that was almost double what it was in early March. The distress ratio went to an almost record level of 33%, went as high as 40%, and as of yesterday was around 34%. That is extremely high, however, not as high as the great financial crisis, when it was 80% or actually 82%. That was astronomically high, but it was a very short period of time. Probably with the markets rebounding dramatically today in high yield, that ratio is below 30%, but I don't think much. I think most of the action on the high yield bond that has come back has been in the double B and maybe B plus area. And so situation changed dramatically. As of the end of 2019, despite its benign cycle, in my opinion, there were many storm clouds on the horizon. And I wrote about this for the last year or more about my concerns. So I'd like to turn to that now. So of course, it is important to understand where we were before the crisis, to understand what's happened since, and then to project things like default rates. Could you go back to the prior slide, please? That's the one. Okay. One measure of leverage in the system is for corporations. These are companies all listed on the New York Stock Exchange and NASDAQ, their debt equity ratio. And the debt equity ratio, as you can see, really peaked from all-time high back in, at least in modern financial markets, back in 2008. And that's not surprising. Since then, it's been much lower. And indeed, in 2019, the debt equity ratio, if you measure equity in terms of market value, as opposed to book value, was relatively low. That's the fourth bar from the right on that screen. However, that was in a huge bull market. I felt it's justified to look at what that ratio would look like if the market dropped by 20, 30, or 40%. I'm talking about now the New York Stock Exchange market dropping by that amount. And you can see on the right-hand part of the graph that the debt equity ratios of these large companies would rise dramatically and be the highest it's ever been, except for 2008, at least in modern times. Next slide, please. This is a very important slide. Maybe you've seen it before in my writings, and I've been showing it now for the last 2 years. The blue line represents non-financial corporate debt as a percentage of GDP. In other words, it's almost like a debt to cash flow ratio for the economy. And notice there's unmistakably 3 prior peaks in 1991, 01, 02, and again in 09. 08, 09, in this debt to GDP level for non-financial corporates. We don't include financials in this data. And then you see In every case, within 12 months, there's been a dramatic spike and peak eventually in default rates. That's the dotted red line. In every case, now we are at a new peak at around 47% of GDP in 2020. But the default rate is quite low. The default rate at the end of 2019 was 2.9%, as I mentioned, and that is slightly below the historic average, although rising from prior years. Next slide, please. What's very important to also understand and critical is the fact that every time there's been a peak in default rates, and that's the line graph here, it's come more or less at the end or shortly thereafter an economic recession. And so one caveat has always been in my writings that we will not have another 10% or more default rate year, which is my definition of a financial crisis, which is more than 2 standard deviations above the mean, unless we have a recession. And I'll return to that recession scenario, and Van has very ably talked about that before. And so the conclusion, if you go back to the prior graph, one moment, the conclusion is that that new peak in default in debt levels, if followed by a recession, which is unmistakably the case now, we will have a record amount of defaults, dollar amount. I'm not necessarily saying a record amount in default rates, because the size of the high yield market, which is about $1.5 trillion today, is much larger than it was back in earlier times. And so there's no question in my mind we're in for an increase in defaults. In fact, the Fed recognizes that and is trying in their best case to shore up that market, as witnessed by today's declarations as to support for even ETFs in the high yield space. Okay, now the question going forward, therefore, is what is the likelihood of a recession, how long it will last, what kind of recession it will be, and the like. Which leads me now to my forecast for default rates in the high yield market. Now, it's very hazardous to forecast default rates because there's so many variables that may be different now than in the past. And certainly this pandemic is different than anything we've ever seen. However, we have to look at fundamentals, and we have to look at what the market is thinking as well. And so my forecast for default rates rests on 3 different models. And I hope you've, if you haven't read about them, we can easily send you materials on that as well. And by the way, all of my remarks are in a paper that will be sent to all listeners to the, in fact, all registrants, even if you're not listening today and you listen later on to this webinar. Now, the forecast has 3 main components to it. The first is a concept of mortality rates. If you go to the next 2 slides, thank you very much, Livia. The next one. Okay. Some of you may know that we developed a model called the mortality rate approach to looking at expected defaults in the corporate bond market. We did this in 1989, and we've updated the statistics ever since. This chart in front of you shows expected default rates in the total corporate market based on original ratings from AAA down to CCC. This is an actuarial approach. It's the only one out there that looks at the aging effect on corporate bonds and how that impacts expected default rates over time. As a result, if we know new issuance by credit rating from their original issuance going back 10 years, we can forecast going forward, given these inputs, based on more than 3,500 defaults and well over 1 million new issues in the corporate bond market over this period 1971 to 2019. So for example, a single B has an expected default rate of 2.8% in the first year, marginally 7.6% in the second year, and so on. And so we can use this technique to look at new issuance and forecast default rates. Using that technique, the next 12-month default rate is slightly under 6%. The other two techniques we look at are market indicators. What investors in the high yield bonds are expecting or requiring in terms of yields and spreads, and the distress ratio, that percent above 1,000 basis points in high yield. Both of these escalated dramatically in late March. Yield spreads were about 1,000 or a little over 1,000 basis points. That doubled from early March, and distress ratio went to as high as 40, and as of yesterday was 34%. It probably has dropped below 30% today, or because high yield is making a big comeback today. And so that distress ratio, but it's still the second highest ever compared to 2008 when it was 82%. Putting them all together, my forecast for the next 12 months was 7%. That's lower than most of the other people who forecast. And by the way, it is hazardous to forecast. Someone once said, never forecast. But if you do, never put it in writing. But if you do it frequently. And my quote competitors who forecast out there do it very frequently. We generally don't do it that frequently, but in today's markets, we really must do it. And so that 7% default rate, if you then factor in the triple B factor, and that's an important one that I don't have time now, but maybe later on we can talk about, then the final forecast is around 8% for the next 12 months. With that introduction and commentary on, we now need to talk about, finally, the recession. There's no question the second quarter will be a very dramatic drop in GDP, and most people have already said it's going to be a recessionary, strong recessionary period. The question is how much beyond Q2? And Van Hesser has talked about this as well. I've done some surveys and I've done some analysis myself and listened to a lot of the macro people. And there is a debate out there whether it will be beyond Q2 or Q3. I think most people think it will be beyond Q2, certainly into Q3. And I did a survey in a couple of recent webinars, and most, I'd say the majority think that it will go into 2020. The government is doing what they can to reduce that, trying to open up the government as soon as possible. But here's the problem. If we open up the government, lockdown and the industries too quickly, and the recession looks like a W as opposed to a V or even a U. A W means that you got a V, you've got a recovery after a big downturn, and then there's a secondary hit to the market, mainly due to the health crisis coming back again, which is, unfortunately, what we're now seeing in places like Japan and perhaps other places. And and it's a real mistake if we open up the government, the economy too quickly and then suffer that. So we really have to be confident that it's going to be longer. I would say my own guess is that it's going to be a lot longer than Q2. But I'm no macro forecaster, so take that with a grain of salt. With that, I complete my formal remarks, and I'll turn it over to my colleague from Columbia, the Uptown School up there, and that is Harry Mamaysky from Columbia.
Thank you, Ed, and very good pleasure to be here with all of you today. So Van and Ed gave an excellent overview of the macro and the credit backdrop that we are now confronted with, and things certainly are very challenging out there in the world. If you can go please to the next slide. So I thought it would be very useful to take a brief tour in the recent history of market crises. And what I did in order to do that is look at 4 important market indicators, which you see here in this chart. In the upper left-hand corner, you see the VIX. The VIX is an index of short-term implied volatility in S&P 500 options, which a lot of people call the market fear gauge. To the right of that, you see the 3-month return on the S&P 500 index. In the lower row on the left side, you see a chart of BBB corporate bond spreads. And to the right of that, you see the 3-month return of the high yield index. The letters you see superimposed on the market variables mark crises that have happened over the last 30 years in the global economy and in markets. First, you see the first Iraq War. Letter B is the Asian financial crisis. C is the Russian crisis. D is the Enron WorldCom bankruptcy situations. Then E, of course, is a great financial crisis, followed by the Eurozone crisis, which takes us now to the COVID-19 crisis. And what's interesting to note about this is that while things are not good, and certainly the human toll of this tragedy has exceeded that of prior market episodes, this is not the market's first rodeo. What we're seeing as stress reactions across all 4 and other asset classes that I'm not showing you are not unprecedented, even in the last 30 years of market history. So to make that statement a little bit concrete, if you look at the high yield 3-month return, which is the lower right-hand chart, you see that while prior to today, the last 3 months have been very stressed for high yield, this kind of stress is not unprecedented, and in fact has been equaled in several other occasions in the recent memory. So things don't look good, but where we stand now is not unprecedented, even in recent history. But if you've been reading the news, and I'm sure as I have, all of you have been keenly focused on the news flow around this financial crisis, the news has been extraordinarily negative. For every one story about someone who recovers from COVID-19, we have had dozens and dozens and dozens of stories of people who have suffered tragically from it. Of course, despite the fact that many more people have recovered and ultimately will recover than have suffered, that's not the kind of tone that we see in how this crisis is being covered in the news. So you go to the next page, please. There's been a lot of talk about the Great Depression. I have some headlines that I pulled, not on purpose from the Washington Post, but they all happen to be from the Washington Post. Let me just briefly mention some of them. The first one talks about the Great Depression being not so far away, and senior citizens describe the struggles from the past and how it parallels today. The second headline talks about how we're making our own mistakes this time around, and it talks about the Dow's recovery being eerily similar to those dark days when the index rallied only to again plummet in the 1930s, all of it having been a false dawn because the worst was yet to come. The third headline says unemployment is the worst since the Great Depression. 10 million were idle last month. And finally, there also talk about market surges and saying this is the biggest one they gained since the Great Depression. The Great Depression forming the benchmark of the entire conversation. What's interesting about all of these headlines is that none of them are about the current COVID-19 crisis. 3 of them are about the great financial crisis of 2008, and 1 of them is about the unemployment shock we had in the early 1980s. So another thing that has historical precedent is a comparison and a benchmarking of market and economic crises to the Great Depression. It's happening now, but this is not the first time it has happened. So the question is, how is it that market activity is at distressed, though not unprecedented levels, and the discussion in the media is so extraordinarily negative about the ultimate backdrop that we're all facing? So you can go to the next slide, please. In my other job at Columbia, I spend a lot of time researching how news and markets interact. And as part of that research agenda, I have looked at all articles that Reuters News has carried that have mentioned coronavirus or COVID-19 this year. And largely the news coverage started in January 17th, and I have data up until March 31st. I don't have the last week of data. So this is about 45,000 articles, and I've classified the news flow that covers a crisis into 20 different topics. And I identified a very salient aspect of the data, which is an indicative of a vicious feedback cycle between market action and news coverage about the crisis. There is indisputable evidence that bad market action today, not today, but a generic day, causes bad news to be written by the media tomorrow. That's not surprising. There's also very strong evidence that bad news written by the media tomorrow, again, causes bad market price action the day after tomorrow. And that second bullet point shows how we can get stuck in a very nasty feedback loop where journalists see that markets are plummeting, they write very negative headlines in response to bad fundamental events, also partially, maybe to a great extent, due to what markets are doing, which had been very negative. And then again, markets react to the negative news flow, thinking that it is new news as opposed to things that have been reactionary and written in response to past market activity. So what can stop this cycle? Of course, as Van mentioned, the best thing that can stop the cycle and hopefully will stop is a change in the trend of the virus progression. And we're seeing at a very heavy toll of social restrictions, some tentative moves in that direction. Another thing that helps is what I call the Fed's Draghi moment. The J. Powell Fed has been extraordinarily fast in its response to this financial crisis and this market and economic and health crisis. And ultimately, the market was not sufficiently responsive. And then on March 23rd, the Fed basically said, we're dropping numerical guidance and we're just going to do whatever is needed. We will buy as many treasuries and mortgage-backed securities as we need until things get better in the markets. And post these Fed actions, there's evidence in the data that this vicious feedback loop from market action to bad news to bad market action has actually been stopped. So we are not seeing that type of vicious feedback in the latter part of March. And when I get the April data, I will update the study for that. But that is a very positive development in how the entire news flow and information market feedback is evolving. So we can go to the next slide, please. Another interesting thing that you can learn from analyzing thousands and thousands of articles about the crisis is what has been the general trends in news coverage about this crisis. So here I show you roughly what fraction of all of the media coverage about the crisis is geared towards a particular topic. In the upper left-hand corner of the chart, you see that initially the preponderance of the coverage focused on China. 80% of all the stories in January were focused on China, and that has had a steady decline as the crisis has become from a localized thing in Wuhan in China to a global pandemic. Below that is the fraction of news coverage that looks at European issues. That had increased a lot with the tragedies happening in Italy and Spain somewhere halfway through March, and also has been declining as coronavirus trends in those countries have thankfully stabilized. If you look in the upper right-hand chart, you see the fraction of all news stories that talk about either fiscal or central bank support being provided to the economy, and that chart shows a large secular increase, suggesting that governments and central banks are basically all in. They are doing everything that they can do in order to stem the tide. They're responding extraordinarily quickly. Even we're seeing bipartisan activity in Congress, which is a hopeful sign and may be even will continue post this crisis. And finally, in the lower right-hand chart, you see the fraction of all news stories that talk about drug discovery. And that's really positive because our entire healthcare apparatus, our drug companies, our university research labs, I know this firsthand at Columbia, I'm sure the same thing's happening at NYU, the entire intellectual resources of our country and the Western European and Chinese researchers is geared at figuring out how to solve this thing. And you can see that orientation being reflected in progressively more news coverage about drug discovery. In fact, there was a front page article on the online edition of the journal this morning talking about certain progress in the drug discovery pipeline. So we go to the next slide, please. And the final thing I wanted to point out, so this is a slide that I did yesterday. Yesterday, the J&K ETF was trading at a 9% yield. It's trading at a 7.4% yield today after the Fed said that it considers part of its mandate to buy high yield ETFs, of which J&K and HYG are the two biggest. But I wanted to make the point that even if Ed's very well thought out and articulated loss forecast of an 8% default rate with a 64% loss given default materializes, in the base case of yields at such distress levels as yesterday, even with such a severe default cycle, the total return that you would have had from investing in high yield had you bought yesterday and the default cycle materialized as predicted would have been 4.98 or 5% of your investment. That's the middle column under the base case. If things got better, if I thought the benign case would be yields would fall from 9 to 7% over a year, it actually fell from 9 to 7.4% over 1 day. But that benign case would have been better. And also there was a severe case where you could have lost money if yields had backed up, although I must say, barring a really unexpected turn in the progression of the virus, given all that the Fed and other central banks globally are doing, it becomes progressively harder to see that 11% scenario materialize. So with that, I'm done with my remarks, and I'll turn it back over to Bill, who's going to conduct the Q&A part of our call. Thank you very much.
Thank you, Harry. All very interesting, all of you. As we receive and sort through some of the questions, I'd like to mention again that as an NRSRO whose ratings are eligible for new Fed and Treasury programs, KBRA stands ready to provide required ratings along with our thoughtful research to those taking advantage of these programs. I also would like to make everyone aware of the strategic relationship we at KBRA have forged with Professor Altman. We now have a long-term exclusive licensing arrangement with Ed to maintain and distribute his corporate default databases that extend back to the 1970s. These have been compiled into proprietary indices and are supported by a range of data analytics covering both the loan and bond markets. We are making this product available. For more information, please contact us at the email address defaultsubscription@kbra.com. Again, defaultsubscription, one word, @kbra.com. Our first question seems quite targeted at Professor Altman, and I know, Ed, you're prepared for this, and as you mentioned, this topic is covered in your paper, and it goes as follows. Many market observers have expressed concern that we have a triple B problem and that a pending wave of downgrades could overwhelm the capacity of the high yield market. Ed, what do your Z-scores tell you about this topic?
Thank you, Bill, for that question and for the reference to the Z-score, which many of you know was a model I built more than 50 years ago, and surprising to me and maybe to a lot of other people, it's still around today and still very much alive and doing well in terms of its usage. While I don't have time to go through all the details on the model, let's refer to that question on the triple Bs, which is a really important one and one that's been covered in the press in the last, say, couple of months quite a bit. To put you the perspective on it, there's been an incredible explosion in triple B new issuance in the last 5 or 6 years, and certainly since the great financial crisis. And this is the lowest of the investment grade categories, now estimated to be close to $3.5 trillion in terms of corporate bonds rated triple B. And the question is now, how will this segment of the market, which is a one that's been really captivating companies, and indeed it's maybe the preferred rating class of all rating classes today, and that is what will be the impact of a downturn in the economy and in default rates on that triple B segment, and what impact that downgrades will have on default rates as well. So going both ways. And so if you look at the press on the triple Bs, and particularly that coming from most of the credit rating agencies, but also others, the general summary of those press releases is the fact that the amount of downgrades in a downturn of maybe 2 or more years will be relatively small and not that important with respect to its impact on the high yield market and defaults going forward. Indeed, something like a maximum of 10% is estimated. And that would mean an increase of, say, $300 billion at most in downgrades, so-called fallen angels. While I don't know the amount of downgrades, because I don't do the downgrading, it's done by the rating agencies, and of course, what they say may be a self-fulfilling prophecy. What I've decided to do is look at the current crop of triple Bs as of the end of 2019 and see how many, according to the Z-score models, do not deserve to have a triple B rating, but have a bond rating equivalent of below triple B, double B and B in particular. And the results were surprising to many people. And even to me, they were somewhat surprising in the sense that around 35% of either the Z or Z double prime is a model, as I said, more general for non-manufacturers as well as manufacturers, whereas the Z is mainly manufacturing, around 35% look like double B or B. Now, how many will be downgraded? It's not clear, but certainly in the first week or so of the crisis realization in the US at the end of March, already 12 companies had been downgraded, a total of almost $100 billion worth of triple B bonds became now high yield or junk. And here is the big question. What will be the impact? Will there be a crowding out effect? Crowding out effect implies that companies like B minuses and triple Cs and distressed companies, which normally could tap the high yield market for refinancing or use leverage loans or both, will be crowded out by this new influx of perhaps 600 billion to 1 trillion of new downgrades, either downgraded or by the market yield spreads rising to such a high level that they cannot refinance economically. And so I expect a large percentage of those, maybe as much as 20% to be 15-20% to be downgraded. But even if they're not, they will have trouble refinancing. And indeed, in that first 12 companies, by running the Z-score model, the 12 companies have been downgraded, running the Z-score model, all but one to us look like double Bs or Bs at the end of 2019, even before the crisis, and they've all been downgraded to double B or B. And so the generalization is there will be a crowding out effect, and I added 1% to the default rate for that. That's arbitrary. We had no prior history of this in terms of this dramatic increase because the ratio is so high, the stress ratio. And I say it's arbitrary, yes, but I think it needs to be considered. Thank you for that question.
Thank you, Ed. And it seems Treasury may agree with you given what they announced this morning in terms of opening their window for fallen angels. So more to come on that topic, I'm sure. Our second question is very interesting. Much has been written about the shadow banking system, including BDCs, private funds, middle market CLOs, and others. Some assert that these new players have done a great job filling a void left by banks since the financial crisis, but some also say they have helped fuel excessive leverage, especially on middle market corporate balance sheets. The big question is, will these new long-term patient capital players be able to absorb the pending wave of insolvencies and defaults and then better able to insulate the broader economy than banks have been in the past and would have been in this situation? Or will they contribute to a new type of systemic risk? Wow, that's a big question. I know on a lot of people's minds. Van, perhaps you can lead us off on that one. I know you've been spending time thinking about it.
We have, Bill. Thank you for that question. One of the policymakers' goals post the financial crisis was to de-risk the banks, right? You don't want your banking system full of risk, having to focus internally to solve those risk exposures, leading to credit crunch. And so, especially with regard to commercial real estate and leverage finance, actively looked to reduce those exposures in the banking system, again, post the financial crisis. It drove a lot of that exposures into a very willing and growing ecosystem of, as you mentioned, CLOs, credit funds, BDCs, all parts of the shadow banking system that were happy to participate in this market. You had growing economy, you had a global search for yield on the part of investors, and so all of a sudden this particular corner of the capital markets grew spectacularly. It's more than a little ironic that the bank regulators have now recognized this ecosystem as a risk factor in the economy, in large part because the banks have found ways to participate in this growth through warehouse lending and capital markets operations, et cetera. Is it good policy? I think it is, right? It's the right thing to do. You want your banking system to serve in a protected and durable role in the economy, and it should be a source of strength in a downturn, not vulnerable to a run on the bank. Whatever happens out in the speculative grade rated part of the capital markets, which are a very real and bona fide asset class today, is part of what makes the capital markets in the US the best in the world, is it's wide ranging across lots of different strategies for how corporate managers want to manage their particular enterprises and choose the capital structures they want to choose. And then investors can make the decision as to whether or not they want to support or participate in this market. The important thing, however, is to get the banks out of this so they can, again, serve as a source of strength and not contribute or not participate in a financial crisis on top of in this case, a health crisis.
Thanks, Van. Harry or Ed, do you want to comment on that topic at all? Or shall we move on to the next question?
I have a comment on it.
Please do.
If you may. Well, first, how large is that shadow banking? It's a good question. There are estimates out there that it's in the $600 to $800 billion range, which is dramatically higher than it's ever been. Bank of America, I think, came out with an estimate that it's 42% of all commercial lending is through the shadow banking area, and that is huge. And basically, although they are being looked at by the Fed and others, this is a largely unregulated market, and therefore one source of risk that we're talking about. So the question is, what are the risk management techniques used by these organizations, and how effective have they been, and how effective will they be in this new crisis? I have a lot of respect for the companies issuing these shadow banking, like the BDCs and the like, because they are sophisticated lenders. They come from either private equity firms or hedge funds, or specifically been in the business now for a long time, including some of them from the GFC. At the same time, they've never faced a crisis like this, so it's unknown. And in addition to the big sophisticated ones, there's a lot of these online lenders, these peer-to-peer lenders and whatever, that their systems are certainly not as sophisticated, and they will suffer a lot. We'll see a lot of them leaving the industry in this next 6 months to a year. Finally, and this is a very interesting point, one that's both positive and negative, a lot of these loans are to leverage buyout companies that are owned now by private equity firms, and therefore the default risk, given the fact that they have this, in many cases, large sponsor, these private equity firms, is a big question as to whether or not the default rate will be higher or lower, given the credit quality of these companies, which are all high yield and junk, and many of them even triple C's rated, if they were rated. What will be the default rate, given the fact that the ownership of these companies is not traditionally, it's from private equity firms, direct lenders, some of these BDC enhanced companies. My preliminary research into this area shows the following, that the default rate on comparable quality companies compared to companies that are not supported by a big private equity sponsor, for example, the default rate for private equity sponsored ones will probably be lower than it would be if they did not have a sponsor, because of the deep pockets of these private equity firms. Of course, they have to continue to want to sponsor these companies, and the fact that they've got skin in the game that's significant in many cases, and therefore more likely to come to the rescue or provide forbearance or whatever is necessary in this period. Still, the fact that they're unregulated, we don't know how much capital they have in reserve, how much liquidity they really have, is a worrying issue. And that's what an investor needs to understand in their holdings of these BDCs, for example. That's my answer, Bill.
Those are great points, Ed. And I will say on the credit rating side, in particular, the groups that provide ratings to investment funds and to BDCs, and to some extent in our CLO business, we would wholeheartedly agree with your observations. Thus far, we suspect we will see a great dispersion of outcomes depending on the fund and depending on its sponsor. For example, there are hundreds of billions of dollars of dry powder in the private credit market right now, and we would expect the strongest long-term sponsors to use these funds to recapitalize strong businesses whose short-term liquidity problems are outweighed by their long-term opportunities. On the other hand, smaller and or weaker funds with weaker sponsors or with less reputation at risk are likely to have fewer tools available to prevent losses of their investors' capital. A lot remains to be seen, and we agree with your broader perspective. Next question. This is one looks like it's teed up for Van. How materially has the risk of bank failure changed since the GFC, or is the current crisis impact more a profitability concern for banks given their health and their less risky loan portfolios? Van, you mind taking that one?
Thank you for that, Bill. What could make all this worse, right? A financial crisis, right? So we've got to watch the banks. Again, a little alarming that the equity market has sold off the banks to the extent that they have. You wonder if there's, just what the degree of fear of what's on bank balance sheets at this point in the crisis. Now, to be clear, again, in large part because of what happened post the great financial crisis, policymakers, regulators, bank managers, board members, and importantly, investors all directed change in the banking system and aimed at reducing the super cyclical nature of banks, right? So we talked about regulators reducing commercial real estate and leveraged finance risk on bank balance sheets. We know bank capital has increased dramatically over the past decade, and profitability going into this crisis was at or near record levels as really the first line of defense. We also know that an awful lot of asset risk was financed in the capital markets, right? Very different than what goes on in Europe, for example, right? The capital markets here are the predominant financier of the corporate sector. So yes, this feels today like a manageable earnings situation for the banks, right? Loan losses will certainly build through the recession, but government support will be an important mitigant. For context, remember that in the financial crisis, bank profitability was essentially wiped out for 2 years, but that's when banks were loaded up with the very risk that gave rise to the crisis at hand. Today, that is not the case. Loan losses will certainly rise, but they will roll through over a period of time. And again, the important distinction here is the size of intervention on the part of the Fed and the stimulus programs, which are going to be important offsets to the credit deterioration we are bound to see in a bad recession.
Thank you, Van. Again, a lot to come. We have a lot of questions here. I'm trying to sort through here. Here's one that Harry, I think would be great for you, and then Ed, after your comments. Here it is. In recent years, because of attractive yields, among other things, many corporates have self-managed a drift down the credit rating curve, with the result being many fewer AAA and AA credit ratings and many more BBB and BBs. Do you think the current widening of yield spreads will have staying power? And if so, how long before corporates begin to reconfigure their balance sheets towards higher rating? Harry, you have some thoughts on that?
Yes, thanks, Bill. I think it's a great question. So I've actually been doing a little bit of work on this area, and I would think the question has really two parts. One is, do the current level of yields or spreads have staying power? And my answer to that question would be no, I don't think so. I think that by and large, investment grade balance sheets are relatively strong, and due to well-documented demographic trends of people who are retiring and looking to move money out of equities into fixed income markets, I think there's just been a secular shift in demand for fixed income. And I think that shift will carry investment grade credit alongside with it, and also the crossover high yield space. So I don't think that these elevated spreads will be very persistent. That being said, there's the second sort of implied part of the question is, at the current elevated spread levels, would companies still want to target a BBB rating? So I was doing some work on this question actually yesterday, where I pulled the average spread level for companies by their rating, and I also made some assumptions about the tax advantage of debt and what kind of cost of capital firms have to pay for equity financing, and also what are kind of the debt and equity to enterprise value ratios at different ratings levels. And even at the currently elevated and dispersed spread level, BBB still looks to be the point in the capital structure that has the lowest weighted average cost of capital. So the two-part answer would be, one, I don't think spreads stay at these levels for much longer than a few months. Companies can still finance. And even at these levels, I would argue that BBB is still probably the lowest point for weighted average cost of capital for firms, despite the spread dispersion we've seen in the last several weeks.
Harry. Ed, do you want to add anything to that?
Yeah, that was great new analysis. Let me hark back to a little primer on corporate finance. And Harry alluded to it. It's the trade-off between the tax benefits from debt compared to the increased bankruptcy and insolvency costs when you lever up in the capital structure. And this is well known in the corporate finance literature. Academics have studied this over time. A lot has to do with this concept of cost of financial distress. And some of my work have shown that that could be significant, even if a firm doesn't default, but as it leverage levels increase. But the key question is that when firms lever up and they take advantage of the low interest rates in the market, which is what's happened dramatically in the last 10 years, and rightfully so on the part of companies, and something like the BBB level becomes the preferred rating class as opposed to what it was 20 years ago, which was the A level. I don't think most corporate treasurers really want to be AAA, because it means that their cost of equity capital is higher and their use of low-cost debt is very minimal. And so they lever up more, and they lever up to A or BBB status. And so that's great as long as they keep that BBB status and don't get downgraded. And as long as they feel that they can always go back on the curve and increase their equities should the cost of debt rise because of their increasing risk. So that assumes that there is a fairly negative correlation between equity prices and debt prices, risky debt prices. And that was the case until the great financial crisis of 2008. It was around 30% correlation, and now I would guess it's, I've analyzed it, is over 70%, 0.7 correlation between, for example, high yield bond prices and equity prices. So here's the big question. If we have a big downturn and the cost of debt capital rises, even for the BBBs and BBs, although it will be less than, of course, the lower ones, will the companies be able to raise their equity levels to their target capital structures from before in an efficient and economic way? With this high correlation between the two, I have to question that assumption that they could easily or economically raise equity capital to go back on the curve should the cost of debt become too high. Now, Harry doesn't think it's going to happen. I happen to think it will last longer, this higher spreads, and will, in my opinion, increase from the level today. Yesterday, it was about 900 basis points yield spreads for high yield bonds. It's definitely lower today with the Fed announcements, but I think it's a temporary on top, and it will increase again, especially if the health crisis takes a downturn, which of course we hope it doesn't.
Thank you, Ed, and thank you, Harry. Those were really, really thought-provoking answers to that question. We have quite a few more. I'm going to say one more. I know we've gone a few minutes past our allotted time, but we still have a lot of folks on the phone, so we'll entertain one more question. Actually, there are two that I want to comment on. One is a question about our assumptions for the energy sector. We just published something yesterday on the energy sector that takes a look at all three segments, at least as we break them up. So feel free to go to kbra.com for that report. And that allows me to get to one other question that I think has been repeated a number of different ways and very relevant to this morning's news. So the two questions are related. If the current market events and conditions aren't worse than past crises, why is the Fed taking such extreme measures? The flip side of that question is, given that the Fed, Treasury, Congress, everyone seems all in to make sure things don't get out of hand, have these actions been enough? So we have two questions. One says, is this been enough? And another question saying, well, what happens if this is too much? I think all three of you probably have some thoughts on those, but Van, maybe you can kick us off.
Sure, Bill. So, you know, one of the things I think that came out of the financial crisis was, and I alluded to it in my remarks, is just how highly politicized that particular episode was. It was localized, of course, in the banking system at its start, very controversial about taxpayers bailing out bankers. A lot was learned, I think, in that episode by policymakers. This particular crisis, not politicized, right? Every man, woman, and child is at risk. And so I think it made it was a clearer path to putting the really extraordinary support measures in place. this is really a humanitarian crisis, right? I think estimates are as high as 80% of the job losses that we're looking at are going to be lower income. There's an awful lot of the American economy that lives paycheck to paycheck or is a small business that needs a wind at its back. The issue here, given the particular nature of this crisis, is that you've got to find a way to preserve as much of the economy as you can. And that means a very difficult task of trying to get money down to individuals and small businesses that need it and need it really quickly. Is it enough? I think from a policy standpoint here, you're not supposed to come up short or try and get it right. You're supposed to overshoot. And I think markets have been relieved and very pleased by the size and the speed at which the government has acted. Maybe not so much on the health crisis part of this, but certainly on the financial crisis part of this.
So I agree with, so this is Harry, I agree with everything you said. I wanted to just mention one more thing. So there has been an unprecedented both fiscal and monetary policy response. And what a risk now is that the governments and the central banks that are doing these policies have to maintain their credibility with the market. Like that, thankfully they have. But to me, that is the big concern that's out there now, is does the Fed and does the Treasury stay credible with investors? The signs are good. How do you tell? Like, look at the currency markets. The dollar is doing very well. The euro, the yen, the pound, which are currencies of other central banks that have gone all in terms of their virus response, are also doing relatively well, at least compared to the dollar. And the dollar itself is doing well compared to other currencies. So that seems okay. Weakening currencies, you might think, would manifest themselves in higher commodity prices. Dollar worth less, so commodity should cost more dollars. Well, we're not seeing that. We're not seeing commodity price. If anything, it's the opposite. Oil is lower, and broad-based commodity indices are also much lower than they were. And finally, you can look at precious metals. You look at silver, of course, as an industrial and precious metal. That's been the price has been very bad. Gold is up a little, 11–12% this year. So that maybe is a little bit of a warning sign that people are a little bit concerned that governments and central banks are doing maybe too much. But by and large, I think the market is maintaining complete confidence in the government's ability to borrow, low yields across the developed world, strong currencies, and the central bank's ability to provide intervention without devaluing the currency. So I think those are risk factors, but thankfully on all of those measures, I think we're doing okay right now.
Well, my comments are not as bullish as Harry's and maybe Van's, although Van has some concerns also. First of all, I think it was pretty much unanimous that the market felt the government needed to do more than what it did initially with the $2.2 trillion stimulus and the Fed extraordinary actions. And so, but maybe we were surprised today how quickly they did it. They didn't wait any longer, and that was very, very good on the part of the Fed, and it shows their all-in thing. So that's very positive. So all that, and the fact that they're going to continue to do that, maybe even more, is now pretty much on the table, and many people believe that will be the case. Now, if they do more, it'll be admitted that the old policies are not working as much as they had hoped, but people hope that they will do more. My concern is the fact that what will it take for the economy to turn around, even with these stimuli? And we look at that as three major important components, and this is not anything that revolutionary, but you may have heard some of these before, but for all of them to work at the same time or within a short period is difficult to envision. And that is for the consumer to start spending again in large amounts. Yes, they're going to spend more when they have more money in their accounts, when they are perhaps not as many laid off, as seems to be the case now. But they're not going to spend, I don't think, a lot on some of these discretionary items because they don't know how it's going to last. And it's been a real trauma for many people to have gone through this process, not only being unemployed, but fighting to get their unemployment insurance, and also to finally realize whatever monies is coming from the federal government. Second, the companies need to start operating again, even if they've been paying salaries, taking advantage of these stimuli, low cost or zero interest loans, not having to pay back in a year or so. Will they start producing? Well, a lot has, and will it go throughout the entire supply chain? A number of the experts I've heard are pretty pessimistic that the supply chain, which is almost broken in many cases, will recover that quickly. And finally, the financial markets need to start normalizing. Liquidity needs to come back in the system. And maybe that's the easiest of the three to envision, because we've seen indications today and in the last week or so that at least good quality credits are able to get amounts. But notice, it'd be very interesting to look at that distress ratio, which was 34% yesterday. What will it be in a week's time? Those are companies, again, who are whose debt is selling at more than 1,000 over treasuries. Will this new stimuli help people at that level, firms at that level, or is it mainly going to be for the triple Bs, double Bs out there? And so they're going to be supported now by the Fed. But is the Fed really going to come in and support the triple Cs out there? I think that's unlikely. And so it'll be very interesting to see what happens to this distress ratio over the next week or two. That's my answer.
Ed, that was, as always, very thought-provoking, and perhaps keeps us all on pins and needles for yet another weekend. With that, I would like to thank everyone for joining us today and for staying with us. So many of you have stayed past the appointed hour. Thank you, Ed. Thank you, Harry. Thank you, Van. We look forward to another conversation sometime soon, and we will publish quite a bit more on many of these topics. And as Harry and Ed mentioned, their papers will be available to all who signed up for the webinar. And we thank you and wish you continued safety, health, and happiness for the holiday weekend. Thank you.